So let me talk first about the theory here. So remember, at present, we're in a bit of a bubble when it comes to inflation and interest rates, starting back in 2023 when we first saw Russia go to war against the Ukraine. That led to the cost of living crisis, increased energy prices, and increased inflation and interest rates that we're seeing today. So if I start with the fundamentals on interest rates, so higher interest rates attract foreign capital that for rates that offer better returns on investments in that currency. This increases demand as investors seek higher returns. The demand for that currency increases. Uh, this leads to a currency appreciation of the currency's value. Then, if you look at lowering interest rates in different economies, this would lead to the reverse. So, reduction in foreign investment, so lower interest rates offer less attractive returns, discouraging foreign investment. This obviously leads to a decreased demand with less foreign capital inflow. The demand for that specific currency decreases, and that reduced demand leads to a depreciation of the currency's value. So then if we take a look at inflation, so higher inflation leads to a reduced purchasing power. So this erodes the power of the currency, making it less valuable, which in turn decreases the confidence across markets, leading to a potential sell-off in that currency. That sell-off leads to a depreciation in the currency, and its value will fall. If you look at an economy with lower inflation, this enables stable purchasing power and helps maintain the purchasing power of that currency. This does the opposite of higher inflation, which increases confidence with predictable value of the currency, leading to increased demand, which leads to currency appreciation. So if you look at the two collectively, in theory, higher interest rates and low inflation means positive for the currency, and low interest rates and higher inflation means currency weakness. So when you take into account how interest rates and inflation impacts the value of currency, you also need to take into account market sentiment. So expectations of future changes for interest rates and inflation will impact the value of the currency and can be priced into the market. So there are a number of countries that have a significant impact on currency fluctuations. Most are obvious, some less so. There are a number of factors as well contributing to the global impact of these currencies due to the size and importance of their economies, the volumes of their trade, and the influence of their financial markets. Currencies are often referred to either major or reserve currencies, and I'm going to talk through the primary ones now. So first and foremost, in the United States, we've got the US dollar. It's considered the global reserve currency, and it's the world's primary reserve currency, widely used in international trade and held by many of the world's leading and emerging central banks. You also have to take into account the economic size of the US, in that it's the largest economy in the world. And from an interest rate policy perspective, decisions by the Federal Reserve on interest rates and monetary policy in general have far-reaching effects on global markets, as we're currently seeing. Then if you look at the Eurozone and the euro, this is known as the second reserve currency, and it's the second most held currency held widely across the world and in the European Union. It's also got a significant economic bloc. So the Eurozone compromises multiple influential economies like Germany, France, and Italy, to name a few, and makes up a huge part of the world's GDP. There's also the European Central Bank. So policies and interest rate decisions by the ECB can significantly impact global markets in the same way as the US. Then if we touch on the UK, as I'm sure everyone will know, it's considered the financial hub of the globe. So it's one of the world's leading financial centres. We hold significant economic influence in the UK, and central bank policies from the Bank of England are watched closely by global investors. And hot topic, I'm sure, for most of you, the impact of Brexit. So events related to Brexit have caused significant fluctuations in the value of the pound over recent years. Just going to touch on China as well and the Chinese yuan. It's the second largest economy in the world, and the trade influence that China has as a global exporter definitely impacts the global currency markets. And the People's Bank of China actually monitor the value of their currency very closely and interject when applicable. Another one I just want to talk about is the Japanese yen. So this is considered a safe haven currency, often sought during times of global uncertainty. So it's particularly strong at the minute. They hold significant economic influence. Japan has the third largest economy in the world. And then from a monetary policy perspective, the Bank of Japan's policies are, I suppose, slightly different from what you've seen in the UK, the US, and the Eurozone. They've introduced some unconventional measures like negative exchange rates, negative interest rates, which can impact the global currency markets. And Japan actively manipulate their currency to set it at a level that they're comfortable with. I'll just name a few others very quickly. So we've got the Canadian dollar and the Australian dollar as commodity currencies that are ones to watch out for. And you've also got the Swiss franc that is considered an economic stability currency and a safe haven currency during times of uncertainty as well. We do also have emerging market currencies, which are gaining more importance as these economies grow and integrate more deeply into the global economy. These are known as the BRICS nations, so Brazil, Russia, India, China, and South Africa. FX is a byproduct of any client's requirement. So selling a property, moving an investment, future-proofing your wealth. If there's an international element to it, then currency fluctuations can impact that. So whilst expats will be focused on tax implications, legal guidance, and financial advice, foreign exchange, international payments can get missed. The easiest way to mitigate the risks associated here are firstly to understand what the risks are and what the tools are that are available to protect against or take advantage of favorable or unfavorable foreign exchange movements. The best way to do this is always to speak to an expert, so a company like Moneycorp who specialize in foreign exchange and international payments. For us, every client requirement is unique. There's no one-size-fits-all model. It's about understanding what our clients need to do, for what reasons they need to do it, and what timescale they need to operate within. So that we can present them with the appropriate solution. As you can imagine, there are a number of tools that we have available to us to enable our clients to protect themselves against these currency fluctuations. So firstly, you have a spot contract. So a spot contract is buy now, pay now. If you've got an invoice to pay, or you've got a payment that you need to make for any reason that needs to be made instantly, you would use a spot payment to convert pounds to euros and then pay your invoice or your requirement in euros same day or next day. For those looking at, I suppose, more long-term solutions with regards to how to protect themselves against currency volatility, we have forward contracts. A forward contract is a contract that allows clients the ability to secure an exchange rate today or for a date in the future, giving them certainty of the exchange rate they're going to get. So a good example of a forward contract is if you had someone living in the UK whose wealth was based in Europe, they would use a spot contract to manage the deposit payment for the property purchase, and then they would use a forward contract to secure the exchange rate for the completion part of the property purchase up to 2 years later. I appreciate that property purchases don't normally take that long, but that's the ability that clients have to utilize their forward contracts and commit to an exchange rate in the future. We also offer tools called market orders or rate watches. This enables clients to be notified when a particular rate that they're looking for becomes available, or even execute and agree to buy that rate as it becomes available using our banking network. Pure and simple, it's your wealth, it's your finances. Without knowing and understanding how currency fluctuations can impact that, then you're really left blind as to how to protect against it. So to give a few examples, Currency fluctuations can impact your financial planning and budgeting. So many expats earn income in one currency and incur expenses in another. Fluctuations in exchange rates can significantly impact their purchasing power and their cost of living. You'll also see expats often sending money back home, so understanding the currency dynamics helps in choosing the best times for remittances, ensuring more value is being transferred to those family members back home. This then leads into like investments and saving decisions. So when you're looking at your investment portfolio, currency fluctuations can impact the value of that investment. For instance, a strong home currency can devalue foreign investments when converted back. So it's something that you need to take into account when managing international investments. It's also worth looking at your savings. So interest rates influence the return on savings, and you need to understand where your money is going to work best for you. So which country's banking system offers the best rates, and how inflation might erode those returns. We've touched on risk management. So there are a number of hedging strategies, solutions that we can offer to protect against adverse currency movements. But by understanding the risks that are there for you, helps you to diversify your investments and reduce exposure across any one single currency. And then if we look a little further ahead for retirement and long-term financial goals, like pension planning, so currency fluctuations can and will have an impact of the value of your pension, long-term and retirement savings. Even on a monthly basis, your pension could be worth more and less depending on what rate is available at the time. And understanding those dynamics is essential in the long term. So for expats, understanding the interplay between interest rates, inflation, and currency values is essential for effective financial management. It impacts day-to-day financial decisions, long-term investment strategies, and overall economic well-being. By staying informed, expats can better navigate the financial complexities of living and working abroad, ensuring greater financial stability and security. I think for me, the number one thing that if those that are watching can take away from this blog, it's that you seek the relevant guidance from a currency specialist. It's a market that's grown. It's a market that continues to grow. And as the world gets smaller and, expats increase, the cross-currency requirements are only going to be more significant. And we've had some significant changes in currency landscapes with huge moves over the last few years that do have significant impact on expats' wealth. So absolutely seek the relevant guidance from an expert. If that's Moneycorp, great, we're here to help. But if it's not, and it's an expert within the field, then you're on the right path to making sensible decisions when it comes to international money movement.